Hi, Steve Thomas here with the Thomas Group and Real Broker, your local Las Vegas and Henderson realtors. Here today I have David Yurovchak with me from Guild Mortgage here in Las Vegas. And David, if you aren't familiar with him, he's been on our videos many times. He is one of our primary lenders, mortgage officers. So when anybody contacts us and they say, have you got a good local lender? We say you need to speak to David. So we thought that would be a good idea to do a little video and give you guys an idea and an insight into what's happening in the real estate market, but from like the eyes and ears and perspective of a loan officer. I've got a whole bunch of questions that I'm curious to know the answers to, and a lot of these are kind of frequently asked questions that we're hearing these days, primarily regarding interest rates, because interest rates are a very, very hot topic right now. Because if you bought a house back in 2020 through 2022, you've got an incredible deal on your mortgage rates, and people have kind of almost believed that that is the new norm. But as interest rates have been slowly increasing, it's been dampening the market a little bit in terms of buyers. So David, thank you for joining us.
Thank you for having me.
Just very curious as to what your thoughts on the current real estate market and the interest rates being where they are, and maybe what's your prediction for interest rates moving forward for the rest of the year?
No, it's a very good question, and it is something that we talk about every day with every client that we come across. So it's a matter of education and open communication on what that payment actually is going to be. Interest rates, I get it. We want the lowest of the low. Everybody wants the lowest of the low. But it's helping people understand that this is where we are now, and more than likely we're not going to see it dramatically drop down again. So what does it mean today for you to get a 5 or 4.875 or 5.5? What does that actually mean in a payment? How can we figure out how that works into a budget, what that means as a purchase price, how does that affect a down payment? Is sitting down with the individual and going together with Steve and his team and the Thomas Group do an amazing job at taking the data that we get and give to you as a consumer and taking it and say, okay, this fits your specifics because of XYZ reasons. Let's stay within that because of this. So rates in general are always going to move. Every day, multiple times a day, they go up and they go down. So I've been doing this almost 19 years, and I've told Steve in the past that back when I first got in this, people were at 6.5%, 7% on a 30-year fixed mortgage, and they were like, yes. And they were so excited, and it's because that rates prior to that were 8%. And it had dropped down to that, and they were like, oh my God, I gotta jump on it now. And it's all based on, again, affordability, and the payment range is where they need to be able to budget. And that's where we can come in too on those next levels with different things that are on your credit. We can kind of analyze it and say, hey, if you paid this off, this gives you 100 grand more in buying power. And it's as little as maybe paying off a small credit card or paying off the little bit of a car payment that you might still have. So it's putting things in perspective that logically can make sense. And then again, where we had 2020 and we had 2021, that again was just a situation because nobody knew what was going on during that time when everything shut down. Because everything shut down, that's where, thank goodness, the banking world decided to say, hey, okay, let's get this lowered for the time being while it shut down. And as things slowly started to open up in the United States and all over the world, that's where you started seeing rates go back to normal. And we've talked about this before in the past, that interest rates right before the pandemic, probably even in March of 2020, we're close to 4.5% to 5% at that time, and nobody remembers it. So we talked about this also in a couple weeks ago, where there's graphs that are out there, and we can probably even create one, where rates, again, are always kind of going in this direction ever since 2008. And you just had the pocket of a 2-year period, where if you take that pocket out and you see that graph as where we are now, it's a natural progression. So it's all education. It's making sure people understand numbers, and we don't predict the future. That'd be great. I'd be a multi-billionaire if I did. But if we can at least educate on that payment, that's what we will always go back to.
Yeah, and I think, we can't predict the future, but we can certainly look at trends of the past.
Agreed.
And we've got a lot of data, right, to look back at many, many years showing the interest rates will naturally be increasing. So I know you don't have a crystal ball. However, with that being said, do you think that we are probably going to start seeing further interest rates throughout the rest of the year?
I think because of what's happened here in the last couple months, I think we're going to plateau for a little while, to be 100% honest, where the data and the reports and the articles and the different information that's out there that we as mortgage bankers do have access to. Also too, so Guild is the bank, and we can also broker. So we have a lot of data that we collect and read every single day based on different things that different experts with Fannie Mae and Freddie Mac and all the different big entities are saying, hey, this, and this is potentially coming. So I believe because of what's recently happened, I think we're going to level out for quite a while. And then it's going to keep trickling. But I do think we've seen the bigger jump where people are like, oh, okay, this makes sense. Let's get back in it and let's go.
Yeah, I'm glad you mentioned, being a bank and a broker. Because a lot of people don't understand, the differences in that. A broker will just, sell the mortgage back on, but the bank has the ability to fund it as well. And one of the reasons that we like working with David and Guild Mortgage is for that reason, because they have so many different programs available for every different type of buyer that it's extraordinary. And in fact, we're going to do a separate video just on some mortgage programs that are available out there that if you're shopping right now, you absolutely must take advantage of. But one program that I'd just like to ask you about now, which we've been seeing in the new construction space, because David and his team do a lot of financing on new construction homes, is rate blocks. Because the builders nowadays, with the process taking anywhere between sort of 7 and 12 months on an average, are now offering buyers a rate block, which essentially means once you enter into a contract to build a home with them, they will lock the current interest rate for you. And then if it happens to go higher, throughout the year, then, good for you. If it happens to go lower, then they'll do what they call a float down. And David, if you could just elaborate on that and tell everybody if that's a sort of a service that you guys offer if you're doing financing for new construction.
Yeah, like what Steve was saying, so we do a lot of financing with a lot of the big builders, and whether it's in a backup capacity or as their primary lender, so it just depends on which builder it is. So because of that history that we do have, we do understand that it does take time to build, but it also can scare people because nobody knows what's going to happen tomorrow, let alone a year from now. So the long-term locks that we offer is pretty simple. So you can do 120 days, 180 days, 270, all the way to 360 days. So it all comes down to communication with the Thomas Group and Steve in particular to know what we are dealing with for the builder. And if we are talking to their salesperson or the superintendent or whoever it is that possibly controls that, they'll give us a good indication. They'll say, hey, it's at the framing stage. We're probably 4 or 5 months out from here. Or, hey, we just broke ground on this thing. You're looking at 8 to 12 months. So as long as we have that data, then we can do the education part and say, hey, okay, we can cap your rate at 5, 5.5, 6, whatever that individual qualifies for the program that it is. And it takes the worry out of the, oh my God, what's going to happen? They can control what they put in the house with the different upgrades, and those are things that we can finance in, which is really cool. But this is a way to the best analogy I've used is it's kind of like having an insurance policy on your interest rate and your payment, right? You know what worst case is going to look like, and it's there and it's going to be protected. I'm not a big gambler by nature, just in general I'm not. So we push people to do that, and it's worked in the past when I've done these probably in like 2017, 18, 19, when we had a little bit of interest rates that were going up and down, where it did save people a ton of money because interest rates at that time were maybe 4.5%, and rates did go to 5%, they were capped at that 4.5% and protected. The cool part with what it is now, let's say just for easy math, let's say we lock you at 5.5%, rates go to 6%, we're safe at the 5.5% for however long we did do the lock.
Okay.
If we do the same thing at 5.5% and rates drop to 5% right before closing, it's 30 days prior to closing, and we are very open and discuss exactly how this works. There's no hidden agenda. And say, okay, we can jump down for free to get the 5%. We say the word free because free sounds great, but nothing in life is ever free. There is a deposit that you do get credited back at closing when we do the lock. So again, let's say the house is $600,000, just for argument's sake. 1% of that would be $6,000. It's half of 1%. So in that example, that would be $3,000.
Is that the deposit or the cost?
That's that's only a deposit.
Okay.
So like your earnest money deposit, which Steve and the Thomas Group explain exactly how the earnest money works if you don't know, is let's say it's $5,000 to secure a lot or a contract. That extra $3,000 would be added to that number, so $8,000 in this math. that money would be allocated or put down as part of the down payment at closing. So the individual, the client, doesn't lose it, and they get to protect their interest rate.
That's really good. I actually didn't know that. I thought the $3,000 was actually a charge for it. So that's it. I mean, so why wouldn't somebody use this program?
I think if they thought interest rates are going to dramatically go down during the next 12 months, I think that was kind of what happened in 2020 and 2021, because we were all spoiled during that small period of time where they didn't want to take a 4% interest rate when they could have had a 3.25 or 3.5. And they're like, I don't know, this seems really high.
Got it.
But now that we have a lot more education that's out there and the market has moved and it's becoming, we're here at the Federal Reserve saying rates are going up, people, again, want that protection. They want to know that budget. Nobody wants a bad surprise ever during the process, specifically on the payment. So it's the easiest way to diffuse that and know what you're getting well in advance.
Talking about bad surprises, I'm just curious if any of the contracts that you have with buyers right now that were building a home with the builders, that started the process last year, and now they're getting closer to building now, and they're now looking at the interest rates being, way higher than they anticipated. Have there been any repercussions and cancellations of contracts that you're seeing?
Every time during the year, there's always going to be something that changes in somebody's life. So you can never say that this is just an anomaly today because of interest rates. People have different job changes or different things that happen. But builders in particular want you to buy the house. That's their goal. Nobody wins unless you close. Even in the resale market, everybody wants you to actually close. So when it comes down to that is, again, regrouping with all parties, finding out from the powers that be with the builder, with the real estate team, whomever that might be, and say, hey, can we get a little creative in this? And if it's like a house at the end of a phase, they might want to close it out and they'll be willing to maybe kick in a little bit to help and maybe buy the rate down. Or we have different programs because we are the bank and we can broker that we might say, okay, hey, we look at it this way and this can work because of this, and it fits the budget and it makes logical sense. So again, it's a matter of just analyzing, getting the powers that be, coming to a solution. If the math legit does not work, we're never gonna be like, you have to do this, you're forced into the corner, blah, blah, blah. But if we have a resolution and it makes sense, again, if the payment makes sense, that's always gonna be the most important part.
Yeah, 100%. I can't tell you how many times David and his team have come up with like creative financing, where you can move things around, look at somebody's situation, and like you said, with all the different programs and options available to you, help them in one way or another. Now, there's a plethora of programs, so we're not going to talk to you about all of the different options, but know that they are out there. Now, regarding the rate locks, does the rate lock have to happen as soon as you go under contract, or can you enter into the rate lock program at any point?
So two things. So in the resale market, usually those closings are about 30 days. That's kind of the normal. So when you have a resale contract, we do want to try to get it locked as soon as we can. You don't have to, but that eliminates any worry that it's going to change and you know what it is right from the beginning. On new construction is the one that we do the long-term locks for. So that again goes back to the conversation with you guys and going back to the conversation with the builder and the client all together saying, okay, if they start and break ground today, which is not the same day as your contract. So you got to realize that there is a little bit of things and time that has to happen. Builders have to pull permits. They have to do specific things to you that are building your semi-custom home or a custom home or whatever it happens to be, that they got to get those ducks in a row first. So once they break ground, then we can have an even more detailed conversation with the builder specifically and say, hey, what are your projections? Right? You never know because you have labor and you have different things that happen with cabinets, and not that they're bad, it's just part of the process. Right. So as long as everybody's speaking to each other in a manner that is on point where they're like, hey, I really do think it's going to be 9 months and we lock it for 6, that's on me. We would never do that. But if they say it's going to be 9 months out, then maybe we do look at that 270 months or the 360 months idea just to have a cushion or to be safe.
360 months?
360 days, sorry. Yeah, right? 360 months, good. 30-year lock, yeah. So that's a good build. Yeah, you're going to like that house. So on that in particular, 270 days or 360 days in particular is how we would come out of that and make sure that, again, the math makes sense and the timing makes sense.
Got it. So most of our clients who are moving here to Las Vegas are living out of state, and many of you that may be watching this video right now may be elsewhere in the world, elsewhere in the United States. What we've been noticing, which I'm really curious to see if you're noticing this, in your business as well, is the amount of people that are able to now work remotely. I feel like has completely changed the game. Are you seeing that also?
No, it's huge. So we did every now and again prior to the pandemic, some people that worked remote, maybe they had a tech job or whatever, that they literally, it made sense. But now more and more industries, I know it doesn't work for everybody. If you're a nurse in a hospital or, you physically have to go and do that job there, that is something else we got to kind of talk about. But if you truly do have technology that you can plug in on your couch in a new office anywhere in the United States or even all over the world technically, that is something that we see almost every day now. So you have people that are in the Midwest that don't want to be in the snow anymore, or they don't want to deal with tornadoes, or they don't want to do whatever their circumstance is, that they want to be here and they want to be in 300 days of sunshine where they literally are outside. It's amazing. And they can still do their day-to-day job, get paid the same amount of money. As long as the employer is cool with it, we as the bank are okay with it. Okay. And we personally lived it during the pandemic because everything got shut down, but we kept on going. In the banking industry, we were considered essential. So during that part, our office normally has 70 people in it. And we all went remote, which was oh, okay, well, let's figure out how to do this. And we did, a lot more Zooms, and we did a lot more phone calls, and we did a lot more things that were a little different. But the company itself, being the bank, it was really cool because we're oh, we can do this. And actually, we thrived in that where people were more productive, and it was eye-opening. Now we are okay, we can be hybrid. We can have people in the office, we can have people at home, we can do a little bit of both. And we're the ones that are giving the money out and qualifying these people for loans. We're oh yeah, if we can do it, you can definitely do it. So that's where it opened up so many more really cool opportunities for people to come plug in from literally anywhere and have Las Vegas be their home.
Yeah, it's remarkable. And there's definitely been a paradigm shift in people, how they, the things that are important to them, how they spend their time, where they spend their time, how they live. So I feel that, this aspect is, it's not really being accounted for in a lot of the metrics because the demand is still extraordinarily high, even with interest rates, having increased a couple of points. So I was just curious if you're seeing, the same sort of thing as we have. Now, I know nobody fits inside a box, but would you say you're having more clients that are working remotely now than ever before? And what is their main reason for moving here?
Well, the biggest one, and this goes mainly probably to the people of California, is our state income tax. You immediately literally plug in here, and this becomes your home base. You immediately get a raise, specifically just because of taxes. So that's been probably the biggest demographic that has come in, and specifically in the remote space, because of that reason. And the fact that you have that flexibility, and having Vegas be a place of your home base, you can go to California again in a 4.5-hour drive. You can go to Utah to the mountains if you want. You can go to Arizona to catch a spring training baseball game. Everything is so close and drivable, or a 45-minute flight, where they're oh, okay, I can do what I'm doing, but I can do it from there. That's amazing. I want to learn more about that, and then it's up to us and Steve and his team at the Thomas Group to help you understand what that means and how that's obtainable, and coming up with a plan before you fully jump in. That's what we're all really good at.
Regarding people that are buying right now, so if you've got someone out there that's watching this video and they're maybe on the fence about should we wait, is the market going to crash, are the interest rates going to dip, what would you tell them?
Being in this industry for so long, 18 years, 19 years almost here later this year, gives me a really cool perspective because I did this back in 2004, 5, and 6. So I did see what happened during that time frame, and that's when I was learning the business in general. So I wasn't very busy because I didn't know much. But looking back, I realized that the people that were doing a lot of the volume, they were doing loans with stated income. They were doing loans with no documentation. They were doing loans with no down payment, only ARMs, prepayment penalties, the nastiest of nasty. So you saw prices going up and up and up because the demand was there and the programs were there. But it's not a surprise why there was such a correction and they call it the crash, because of that time frame, because nothing made sense. I've used this joke before. You literally could fog a mirror and you could buy a house.
Right.
As simple as it was. And now the best part of the whole thing, and everybody that lived that, I do feel for you, and I do, my heart goes out because it wasn't fair in a lot of circumstances. But thank God the banking industry has come out of it and realized, like, oh my God, we made a mistake. So since 2008, all the way up until literally today, we, on the banking side, I'd say we've done probably in 98% just 30-year fixed mortgages. People that legitimately qualified. They had the assets, they had a gift that was verified, they had the W-2 income, they had the self-employed income. We actually deep dive what they could truly get. And we gave the family a budget, and they stuck to the budget, and they got the house. Also too, we have that, and then we also have so much equity in a lot of people's homes right now that are thinking about buying and they don't know if they want to sell. So that's where you want to reach out to the Thomas Group and weigh the pros and cons. If it's time to sell and to do that upgrade or the move to a different state, they're great at being able to analyze what that really means and using that equity, wherever it happens to be coming from, to have that be a huge buying power here locally that's going to give you a wide variety of options. And that's where I do think the question of, is it going to crash again? I truly don't, because of the mortgage programs that we've been doing for forever now, and the equity piece, and the stability of those people's jobs. That's the three pieces that I think are going to give us so much more equity coming forward. And then I do think that it's going to give people more opportunity specifically to come to Southern Nevada.
Great, very good insight, and that's very reassuring. We can definitely, see the rigorous checks that you guys do with our clients. Reaching out to verify multiple things, income, all sorts. When everybody's now got this as the standard procedure, it's making everything a lot more secure, a lot stable. So I personally don't think that there's going to be any big crash again. No one's got a crystal ball. There might be some black swan event that happens that none of us can predict. But in terms of everything that's happening in the mechanics of financing and banking and real estate, it doesn't look like there's going to be a crash at all happening. The stock market's been correcting for a little while, which right. I think has softened the market a little bit as well. People that would be taking out selling some stock or whatever, that's been dipping. So my prediction is that, for the next couple of months, while people start getting used to the new norm, which is, interest rates in the 5% sort of range, wherever that may be, the inventory is still so low as well, but the demand's so high. I think we're still going to see, a gradual average, a median sales price increase in the median sales price. But I do predict more inventory. However, the inventory is still so low that it's going to take a huge amount more for it to even become a balanced market.
Agreed. And I'd like to also elaborate on, across the United States, not every market is created equal. So we have a unique market here. Washington State has theirs, Hawaii has theirs, California, New York, so on and so forth, right? So a lot of the places, when I talked about the 2004 through 2000, let's call it 7, was across the entire country. Everybody got kind of impacted. But Las Vegas in general did take a really big dip at that moment. And that means that affordability is even more so in places like this, because there are pockets across the country that never took a dip, and they just kept creeping up on prices higher and higher and higher ever since that time frame. So if you hear there's going to be a correction or a dip or anything, I think it's going to be in those pockets, honestly. First, specifically across the United States, before you ever see anything in a place that's such an affordable place like Southern Nevada.
Yeah, I couldn't agree more. Like we have a saying that all real estate is local. And that can even become hyper-local, right? In between communities here in town, when we start looking at inventory in certain communities. Some might be a seller's market, some might be a buyer's market. But, generally throughout the big picture, if you like, I think we're probably pretty safe. So very last question regarding, those buyers that are wanting to move into the market right now. And for buyers that, you've currently been working with, in terms of the offers that have been getting accepted, what percentage of those offers are now having to waive the appraisal contingency, are paying above the ask? Because I know a few months ago and last year, that was basically every single offer. If you wanted to have a chance of getting it submitted, you had to waive your appraisal. And you had to have cash to be able to guarantee the difference between what the appraised price is and the sales price. So just curious if you're still seeing a lot of that.
Not as much, but it's definitely there if the strategy makes sense. And that's where my team is really good at analyzing the math. The Thomas Group does a really good job at saying, hey, this house is probably going to appraise for X. Let's go in, there's other offers on it. There's different programs that we're going to talk about that can potentially compete in that realm as well, but that's for a later time, is where you have people that have to have logic. And again, that education and the math has to make sense. So I do see it being a little less because of the little things that have changed just recently, which is a good thing. I truly do think that's a good thing. I think people do need to be protected to a degree. If the house is pristine and you know that it's turnkey and it's beautiful and you're up against a bunch of offers, it is still probably something that you want to entertain, that you and your team can actually explain to the client and say, okay, this is why we need to do it. And that you do that before you are too deep, right? It's a collective collaboration, and it has to make sense mathematically and with the extra money, or if they're taking money from a different place, we got to talk together and, okay, yes, it does make sense. I think we can do it this way, or I think this is the market where we're in now. Let's go in, let's get a 10-day contingency, whatever that happens to be. That's why contracts are there, and that's why those dates are there, and that's what Steve and his team are really good at explaining.
Yeah, and there's actually a program that you've just released that we're going to do a video about shortly. So if you wanted to know more about some really good loan programs that are out there for first-time home buyers, through people that have own another home somewhere but don't want to sell it and don't want to buy and sell at the same time, stay tuned for that video. We're going to go into great detail on all of that. But just as a kind of little teaser for some people that might want to go and watch that video, there's one program that you guys have just released, which I really wish was available like last year.
Right, 6 months ago.
And it's called the Cash Pass. And I'll let David talk to you, in more details about it. But basically how it works is David and his team will pre-qualify you for this program. And if you fit the criteria, we can now, although you'll be financing the loan, we would write the offer for you as if you were a cash buyer, which is massively valuable because a few things. First of all, you don't need an appraisal, so we can waive the appraisal contingency. You're not using financing, so we can waive the financing contingency. But if the sellers want to close quickly, you can close in 15 days?
14 business days.
14 business days. So tell us a little bit more about this Cash Pass and how does it work?
So it gives you as the consumer the power to compete with the hedge funds, to compete with the people that are coming in with just a ton of cash because they sold the family home or whatever the story is, where you feel like you've been, you missed out, or you got outbid, or again, maybe you had 10% to put down and that offer they accepted was 20%. So this gives the consumer the power, as with Guild backing it up, and we are the bank on this. So we would actually say, hey, Steve, client, we can do this. We'll say you can give $600,000 cash. Guild will guarantee a closing within 14 business days if we can't get the loan done at the same time behind the scenes. So it's a very full disclosure moment. We go through every detail before we even go into offering cash, that we want to make sure that the consumer truly does understand it, that you on your team understand exactly why we're doing what we're doing. But it does give that power and that flexibility to compete in a market that is still very competitive. And if it is that house that just went on the market and it's beautiful and you want it, this is the way to do that, and you're still getting a really good loan and you're not paying over market value.
Like, what's the con?
So the only con is it requires at least 10% down. That's usually in the market that we're seeing, that's pretty common. We do have other programs you can do less down, which is again for a different topic. The other one is that it's $1,350 is the fee, $1,350, only if we use the Cash Pass to get the offer accepted. So we've seen that people have actually gone in and done a traditional offer and actually got it accepted. We had the Cash Pass here in our hand, but we didn't actually use it. You wouldn't be charged the $1,350 if we didn't actually use it to win the bid.
I was going to say that, why wouldn't everybody want to qualify for the Cash Pass and then just use the Cash Pass? But because you've got to pay that $1,350. However, as your realtor, a good strategy, just thinking out loud in a multiple offer situation, is you can put your offer in, with traditional financing, and then if we find out we're in a highest and best or multiple offer situation, we change that altogether into cash.
Yep.
To get to where we need to be to make sure we win the bid on the house, and then boom, we're in.
Exactly. It gives you flexibility, which is really cool. And since we are the bank, we control it. So again, communication, education, and understanding why it works is the most important piece. But once you're like, you have the aha, like ding moment, you're like, okay, let's go.
Yeah, no, I like that. So yeah, stay tuned for our next video on all of the programs that David's got available right now that we feel you should know about. But if you have any questions regarding interest rates, mortgages, loans, David and his team are phenomenal. He's not a high pressure guy. One of the reasons that we like working with them is because they're very, very professional, very, very knowledgeable. And like I said before, the amount of different loan programs that are out there from veterans, first-time home buyers, teachers, entrepreneurs, I mean, you literally, you name it, they've got something covered for you. So David, thank you so much for joining me, and we'll put all of David's contact information on our page and also on our website if you want to get hold of him. But for now, thanks so much for watching. We'll see you again.
Thank you very much.